This is the Rocket City Retirement Show with Chris Wallace. Chris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Chris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hi there, I'm Luann Fulmer. Welcome to our show today, the Rocket City Retirement Show, with my friend, certified financial planner Chris Wallace. He is president of WG Financial Group. And then also joining us from the firm, Graham Bauer. And he is a certified financial planner and a financial advisor as well. We are so excited to have them both here today. They're going to give you helpful advice about retirement planning. Here's our phone number that we want you to have as we get into the show, 256-937-2010. That's how you can reach out to Chris for a complimentary discovery session. Okay, you can call or you can even text the word visit to our number. You can get, on the calendar that way as well, 256-937-2010. Check us out on Facebook. Just search for WG Financial Group 256. And there, if there are any updates, anything that goes on throughout the week, Chris will add anything to that on the Facebook page so you can keep up to date on things going on in the news there. And remember our motto, plan, retire, and play. That's what we want for you as you head into retirement. This show is also available on Spotify and Apple Podcasts. Just search for the name of our show, Rocket City Retirement Show. Chris, hello to you.
Hello to you, Luann.
So excited to be here with you. And Graham, you as well.
Hey, Luann.
All right. Well, my gosh. Okay. So we are about ready to see the inauguration come up this coming Monday. So that's kind of exciting news. Excited to get started on what we're going to talk about today. First of all, with all this happening, Chris, why don't you give us a market update, please?
Yeah, let's go through a couple of updates here. First of all, I want to say this because I don't want it to come as a shock or surprise, but we're going to be rebranding the show here in maybe 2 or 3 weeks, maybe slightly longer than that. But we're going to rebrand it under the Right Retirement Show, RITE, which, as you know, Luann, is kind of our process. We've had it trademarked since 2019,
yes.
And we use that internally. Like that's something when a family or an individual comes in, we kind of use a report card that we have, and we kind of score people and kind of tell you where we have opportunities and where we don't. And it really gives us internally a good look at how we can assist a family or, again, individuals if you're single. So we will be rebranding that under the Right Retirement Show in the coming week. So don't let that shock you. Same people, same.
Yep, same everything.
Yeah, we got more rebrands than the Washington Commanders at this point. So don't forget about us.
Speaking of, I cannot call them the Commanders. I call them the Redskins, even online. I still call them the Redskins.
You could be a real contrarian and still call them the Washington football team too.
Yeah.
For that 1 year.
I'm telling you, it's so bad.
Yeah,
I heard it the other night, and I'm like, it's just even me, guys, who doesn't follow football that much. I'm like, it just didn't sound right.
Yeah, it just doesn't. Yeah. Anyway, we'll kind of leave that one out since we are going to get a little bit political here in a minute on the show. But so again, just going to do some rebranding. Don't let it shock you. It's all good. Same people, same message, all that good stuff. One thing that I just want to bring up again is that we do lunch and learns. So for local small businesses, even some of the defense contractors in the area, we'll come in, we'll provide lunch, we'll talk to your pre-retirees about, what they have in the way of benefits at your company. We'll also talk to them about how to prep for retirement. So we do that. That's something that we do and have done for businesses here in Huntsville. And the reason I bring it up is when we sit down with somebody at the office, what I'm seeing is we know more about their plans than they do. So they come in, they're still working, and we're telling them what they can and can't do within their 401k plans. That is simply because, one, we've been in the area a long time. I've met with hundreds of people in the Huntsville area, and I've seen a lot of retirement plans. And if we don't, we usually are calling the custodian with the client so that we can ask additional questions. Sometimes you have benefits within your retirement plans that you're just not aware of. So we're able to kind of shed some light on that. So it would probably be helpful if some of the small businesses, if you're an owner, president, maybe HR manager listening to the show, it'd be a great idea to just bring us in, set up a time where we could come in and do an hour, maybe, however long you want us to. We can do some sort of a presentation to kind of go over some, do's and don'ts and what we kind of suggest just based upon where they're at in life currently. So just remember that, lunch and learns. As far as the market goes, Luann, we are off to a little bit of a rocky start. If you look at all of the major indices, so the S&P, the Dow, the NASDAQ, the bond index, they're all down. The S&P is down about 0.8. Dow Jones is down about 0.5%. NASDAQ's off about 1.4. And our friends' bonds, I don't know, will they ever be positive again? I don't know, but they're down negative 1.1. So all major indices are actually down right now. And I think what's going on here is I believe there's a little squirreliness, if that's a word, I guess with related to inflation. I think that investors are concerned that inflation is ticking back up. And I think that some are worried that the Feds may actually raise rates in 2025. I've seen a couple predictions out there where articles have said, the Feds may end up raising rates in 2025. Now, I don't know if that's fear mongering, but I do know that there's been a little bit of an upward trend. So if you're looking at what the Fed Fund futures are telling us, we can confidently tell you January the 29th, which is now about 2 weeks from now, there will not be a rate cut on the 29th. I mean, they're going to hold where they're at. Right now, the Fed Fund futures, right before the show, when I screen printed the number, it's 97.3% chance. Remember, as I always say, the closer we get to that date, the more solid that number becomes. But I can pretty much tell you based upon data, we're not going to see a rate cut on January the 29th. We saw the two that we're going to see. We saw two last year. So we saw a 50 basis point cut right out of the gate, which I think was a mistake. And then in December, we saw another 25, and I'm not sure why I think you said last week it kind of felt obligatory to some degree, Graham.
Yeah, it's like they'd been saying they were going to do a couple rate cuts at least in the next year, and it was like, well, it's December.
Yeah.
Guess we got to do one more almost.
Yeah, so I don't think they really needed to do that. So just to look ahead at the 29th of January, I don't think it's going to happen. If you look further out to March the 19th, which is the next Fed meeting, this is again, we're so far out at this point, the data might be a little suspect, but there's already like a 78% chance that there's not going to be a cut even in March. And if you look a little further out at May 7th, you can see that there's about a 65% chance that there's no rate cut. So I think it was you, Graham, last week that while I was talking, went online, kind of pulled this information, and there was no projected rate cuts really through the first half of the year. Now, again, I'm going to repeat it. The further out we go, the less accurate those numbers become, the more they move. But when you're close as we are to January 29th, we can pretty much say there's going to not be a rate cut. The data that's coming out this week, this is important, and this will all tie back to rate cuts and markets being a little volatile. So the PPI, Producer Price Index, came in at 3.31% year over year. Now, that was slightly below expectations. But if you look at the graph, and I have actually the graphs pulled up on my computer, there's a nice little upward trend when it comes to PPI. Now, what PPI is, that's the supply side of things. So that is the seller to the consumer that's making the goods. So if the supplier's cost is going up, well, guess what? That's going to be passed along to the consumer. So tomorrow's number, the CPI number that is set to come out, will probably come out around 2.9%. That's kind of the expectations right now. I would anticipate right around 2.9%. If you look at where it was last month, it was actually at like 2.75. So that would be a slight tick up. And if you look at the most recent data for CPI, it's actually starting to slightly trend up a little bit as well. So, and then if you look at core CPI, so we've got CPI and then we got core CPI, which is core is basically minus food and energy. And the reason they pull those out is because those are pretty volatile. So they pull those out, and the expectation for core is around 3.3. So kind of back to what I was saying earlier, we're kind of off to a rocky start. All right. So I think that investors, both the stocks and bonds markets, that's obviously the investors, I think they're concerned with CPI and the potential for the Feds to start raising rates again. And if that happens, that can be good for some, bad for some. So it's, a sign that inflation's going back up and we got to tighten things up again. So it's going to be interesting to watch over the next few months and the data that continues to come out on whether or not, whether or not the Feds will start raising rates or will they just leave them elevated. Personally, I'm kind of in the camp they're just going to leave them elevated for a while. And I don't believe that and I may have said this before, but I don't believe we're headed back to the zero interest rate policy that we saw during the Obama administration and then part of the Trump administration. I think those days are gone unless something catastrophic happens. I think this is somewhat of the new normal, but I do believe over time they will come down a little bit. But I believe for the time being, the Feds are probably going to remain elevated. So that said, I know that a lot of people are excited because January 20th is the inauguration day. And I say some people aren't excited. There are some that are not excited. Some are not. It's about almost 50-50. When you look at the numbers, slightly tilted, for Trump. But I think people are excited about that. But when it comes to 2025, I personally wouldn't be surprised if we saw a higher single digit return versus what we've seen in the past 3 out of 4 years where it's been 20+%. The reason I say that is I think the market could be a little bit volatile in 2025 because, with Trump does come some unsteadiness, if you will, because he says a lot and people believe what he says and react. Right. So, some of those people are investors. Some of those people are companies. And so when you say a lot of stuff, it's like, okay, what's he going to do? And some people may find that funny. It's like, okay, he's playing his game. He's doing his Trump thing and whatever. It ain't funny to the market. So your market accounts actually pay for that uncertainty because the markets like certainty. They like it when Congress is controlled by both or one side or the other. And actually with the Trump administration, I'm sure we'll talk about it today, they have the presidency in both the Senate and the House. So supposedly they control everything. But when Trump says a lot of stuff, it just brings about some unsteadiness. And I think that it's going to take about a year for that to kind of settle out, the unsteadiness, and go, okay, all right, he said all of this kind of stuff right here is probably going to happen, and this is probably not going to happen. And I just think it's going to take a little bit to settle out, and we may see a little bit of a bumpy year, and I don't know that we're going to hit the double digits in 2025. So we'll write that down, as Van Wilder said on the movie Van Wilder. So with that, we can kind of get into some questions, Luann. I know you've prepared some stuff for us, and we can kind of walk through that, but that's kind of my opener for the week.
Okay, thank you for that. Yeah, so you mentioned next year might be kind of a bumpy year just because, oh my gosh, when we had the election back in the fall and now Republicans have control of the White House, the House, and the Senate, like you mentioned. Mm-hmm. So here's the deal. We've all voted and we all had our say in last fall's election. Now, this isn't a political show. We want to make sure you guys all know that. This is a retirement show.
Sure.
But what I want to know is, what are these votes that happened in Washington? What's that effect going to have on our retirement plan? Anything, do you foresee anything in particular?
Well, first of all, before I answer the question here, I do want to say as we, start the show that one of the best things I think a family can do is build a retirement plan. I absolutely 100% believe that. I have one myself. I have targets and projections, and I don't really worry about the political aspect, to be honest with you. I know my savings targets that I need to hit. I know the types of accounts that I want to save in. Obviously one of those is HSA that we talk about a lot on the show. So I think that's one of the most important things a family can do. So as we go through these questions, as you noted, this is not a political show. This is to kind of shed some light on what we think, how we plan for clients. But I think the most important thing a family can do, and, I will say this most of the time, it's the wife that calls in. Because the wife is like, I want to get this done. And the husband's like, we're good, honey. We're good. Look, we got all this money in the bank right here. We're good. And so I do think one of the best things you can do is build a retirement plan. That said, what impact do these votes in Washington and all of that have? I personally believe it has more, and Graham, I'd be interested to hear what you think as well. I personally believe that it has more of a psychological impact than it does anything. And the reason I say that, I would say that the vast majority of our clients are like, oh, Trump's in office. Yeah, let's go, risk on, let's go. When in reality, long term, the president's only in office at best 8 years. Now we know Trump's already been in for 4. He can only be in for another 4. And my dad actually said to me, "Are you trying to pass a law so he can be in office longer?" I'm like, "Dad, you quit reading that junk. That ain't gonna happen. That's junk. That's fake news. Fake news." Funny. So yeah, I think there's a psychological impact. Now, with all of that said, the votes in Congress and all that, passing stuff like for the tax code, that has an impact, right? We know that. I think that with Trump being in office, I think we're likely to see an extension to the tax code or some sort of revision, but likely to see it kind of stay the same. I think the regulatory environment is probably where you're going to see the biggest impact, and that can have an impact on the economy. But by and large, just kind of what I was saying earlier, Graham, I feel like it has more of a psychological impact. And you were with me in the transition into the Biden administration just shortly after, and now you're going to be with me, unless you've turned in your notice that I don't know about. You're going to be with me as we kind of transition into the Trump administration, and I would just like for you to like compare and contrast what you've seen and heard.
Yeah, I mean, with our typical client, and I don't feel like this is at all strange to say, considering if you're listening to the radio show right now, you're probably listening on, WVNN or one of the local stations.
Yep.
And, our typical client is conservative leaning, a lot of times Christian as well. And so obviously it's no surprise that that's going to be a crowd that is going to resonate more with Trump. And after the 2020 election, I mean, there was definitely a lot of panic. Obviously, there was a lot that transpired within that election. But then it was also just a particularly contentious time in the world. Obviously, COVID was happening. There's everything with the rallies and riots in 2020. It was hectic is the word I was looking for. 2020 was a particularly hectic year. And coming out of that with a presidential election just added that much more. So I think that more than probably any time, again, I haven't been doing this since the great financial crisis, but I would assume there hasn't been a time probably since that point where more people were just ready to jump ship and go into cash. Mm-hmm. And it's easy to see why that would happen with, if you don't like who just got elected and maybe you feel like the scenario that transpired wasn't fair. And then there's all this stuff going on in all the major cities and a pandemic and all of these things happening. I could see how that would, correlate to market crash. I'm going to lose all of my money. And to be fair, there were a lot of people calling for a recession for multiple years following that too. Yeah. That was even stuff that we didn't necessarily call for a recession, but we definitely talked about the possibility of it even on the show multiple times throughout that time. So then, fast forwarding to 2024, it's definitely kind of the opposite, where now you're seeing people. It's been just a big cultural shift overall. I mean, if you're not even looking at just the presidency, you're seeing like stuff that Mark Zuckerberg is posting and the changes that he's making, where the whole political and, social landscape is kind of shifting, a lot more in a conservative direction. And I think that's making people just generally feel more comfortable. But you have to, regulate that as well, because obviously being in cash for the last 4 years would have been a huge mistake.
Horrible mistake.
But I'm not ready to say that being 100% stock as a 75-year-old for the next 4 years would not also be a huge mistake. I don't think we're going to see anything catastrophic like that, that we see on the horizon. However, just because you like how the social landscape of the world is shifting, how the presidency is shifting, Congress, what have you, at the end of the day, like you just have to be looking at where you are in life and where where you are in your retirement plan. So yeah, I definitely see a lot more. We've called it like Trump FOMO on the show before. People are like, they're gearing up for another, 2019 kind of bull run. And we're hoping for that. That would be great, but
make my life easier.
Yeah, there is a lot of uncertainty still. I think, like you were saying a minute ago, words do carry a lot of weight in the short term. So I wouldn't be surprised if, like you said, for the next year, we see some really volatile days, but maybe not necessarily incredibly volatile years. And that's how it tends to go. People will, he'll say something and people maybe freak out a little bit for a couple days, but that doesn't necessarily mean the whole U.S. economy is going to crumble under that over the course of a year, 2 years, a 4-year presidency. So I do think it's good not to panic in the situations where you didn't get what you wanted politically, but also not, be overreacting when you did.
Right. Also, Graham, just on that note, I mean, I think when it comes to the political landscape, it's really more about a family's time horizon, investment time horizon, where they're trying to go in retirement. Do they want to leave a legacy? Are they trying to travel? All of that, excuse the term here, actually pun intended, trumps whether or not you should look at the political person in office. Because if you're trying to spend more money, if you're trying to travel more, if you're trying to leave a legacy, that those decisions really impact your diversification more so than the political person that's in office. So you're right, though. I've seen it. I mean, I've met with a lot of people, and the buzz around people that are coming into the office is much more positive, say, than it was a couple of years ago. Even though, I said this last week on the show, the last 2 years, the market's up 40+%. It's been, I think it's up nearly like 45% over the last 2 years.
Crazy.
3 out of the last 4 have been 20+% years. So to your point about being in all cash, probably not a good idea. No, actually, it was a really bad idea because you missed a lot of market upside by doing so. So it all points back to, Lou Ann, all of this back and forth about the political landscape, et cetera, et cetera. It all points back to build a plan, establish what kind of income you need, establish your portfolio diversification, and leave the stuff alone and make minor adjustments. Don't make radical adjustments. Make minor adjustments along the way.
Yeah, I'll just add one more thing because I've been listening to a podcast series on my way to work and church sometimes and all that about.
Is it the Right Retirement Show?
Yes, of course. Which you can stream on Spotify and Apple Podcasts, by the way.
Plug.
Get a quick plug in there.
Yeah.
But it's a little series. I think it's, probably 6 or 7 episodes. I'm probably halfway through, just about the year 1968. And I do think that one of the reasons they said they were doing it on this history show is because there are a lot of parallels between the year 1968, which was an election year, and a year like 2024, with there being some wars going on overseas. And I think you could probably say Lyndon Johnson and Trump have some similarities personality-wise, maybe not so much politically. However, at that time, there was a lot of turmoil with the Vietnam War and the election going on. Obviously, the Kennedy assassination not that far behind, and there was going to be more Kennedy assassinations, Martin Luther King. There was so much going on. And if at that time, you were an 18, 19, 20-year-old and, 25-year-old even, and you were getting really scared and not investing your money aggressively over the next 40 years, you would have been really sorry that you did that. I mean, I think you posted something on Facebook, Chris, recently that between like 1970 and 2024, even accounting for all these crazy world events, $10,000 would have turned into like $3 million invested aggressively. So even when there's all this stuff going on in the world and all this fear, if you have a long timeline, you don't need to be thinking about that really, because there's going to be so much that happens in between now and your retirement. I was helping a younger person set up a Roth IRA recently, a client's younger kid. And one thing that they asked is they were like, could I lose money doing this? And I was like, yes, you totally could. But we're talking about 40 years from now. If you're down 40 years from now, there's something seriously wrong with the world. So yes, tomorrow you could lose money. But over the course of your lifetime, you really shouldn't be over a super long period. So like you were saying, it really depends on where you are in life and just somewhat tuning out the history, because our goal is not to be day trading all of these accounts and saying, oh, Trump tweeted something, I'm going to go all to cash. And then when he says something else, I'm going to go. No, you're not going to win and beat the market doing that. So, the best strategy is just to be staying invested and not letting it, majorly dictate how you're structuring your portfolio.
Here's the millennial today. Can I lose money doing this?
Yeah.
I mean, also millennial, where do I buy crypto?
Yeah, right.
I know it blows my mind sometimes how willing people can be to be like, oh, I heard about like buying rental properties and leveraging them with, more mortgages and it's like, okay, you can lose money doing that. You can lose money doing a lot of things that can also make you money.
But I saw it on TikTok.
Yeah.
This person was sitting there putting their makeup on, telling me about it. And it's like, okay, anyway. Yeah. We digress. We'll move on.
No, that's good though. So yeah, you're talking about just, it's going to be a bumpy ride, here with Trump taking over and of course all the Republicans taking over. When people are worried about, what's going on with the economy, taxes, things like that, mm-hmm. and they're like going, I do think I want to make some changes with my plan. Tell us how that goes. What does that appointment look like, Chris?
Yeah. So first of all, having a plan, as I mentioned a few minutes ago, incredibly important because that gives you a basis to work off of. And when you're talking about making adjustments, we are not advocates for making radical adjustments. We feel like if you have a plan that's built, then you can make some minor tweaks. A lot of what we know today is what we know today. Like, we don't know what's going to be, what the tax code is going to be in 4 years, because you can pretty much guarantee, even if Trump extends the tax codes, somebody is likely to come in and change it in 4 years. And so we really don't know. So we have to go with what we know today. And even my, opinion of there probably will be an extension, even that's not guaranteed. Like, it still has to pass through Congress. It's my understanding that he can't just pen that into action, I don't believe. So I think it will have to still go through Congress. But, when it comes to, people wanting to talk about making adjustments, part of our job, honestly, is to act, I think, as a coach a little bit, Graham, is just to kind of, if they want to do something that's a little bit off the rails, our job is to say, oh, well, maybe did you consider this or that? And a lot of times you'll hear, well, no, I didn't think about that. I say, okay, well, we got to think about that, because what you're looking at doing may send this off the rails. So making adjustments, I think, is fine. I do think with retirement, as we wrap kind of the first half of the show here, I think there's an element of psychological, and then there's an element of comfort in what you should do. So the plan says that you should do this, but if you're not completely comfortable with that, well, you can't do that. And then sometimes the psychological says, I really want to do this. I feel like I'm very comfortable doing this, but the plan is like, no. You shouldn't go that far. And part of it is kind of what we're talking about a few minutes ago with the Trump FOMO. It's like, people are, if you're right wing, you're excited he's in office, and you're like, yeah, man, way to go. Let's go 100% stock, and let's get into crypto because, Trump said he's going to do this with crypto. But meanwhile, like, you're still in retirement, and you still have to think about making your money last. You still have to think about income generation. You still have to think about, what if, you were to pass away? Is your spouse going to be okay? Does your spouse have someone they can go to? Like, if you're out there today listening to the show and you handle everything from front to back in the financial department inside your house, if you pass away today, is your wife okay? Not only with money, but does she has a comfortable place that she can come sit down and talk with a group of people that she's comfortable with? I've talked about this before on the show, but at our firm, we have 3 certified financial planners on staff. We have Graham, myself, we have Whitney. So we have 3 different certified financial planners on staff. So, when you walk through the door, that CFP certification carries some weight there, because we are obligated to make sure that we're giving advice that's in your best interest before we do ours. That's part of that designation, and we don't take that lightly. And that's why at our firm, I make it so that all advisors that are meeting with people either have to be going through the process, or they must have obtained the CFP designation. We feel like that is a designation that we want advisors dealing with people to carry. And again, that's important to us. So we're about halfway through the show, Luann. So if you're listening to the show and you want to catch the whole episode, as Graham plugged us earlier, you can hop out to Apple or Spotify. If you want to give us a call at 256-937-2010 and set up your discovery session, you can do that as well. Or if you want to do the lunch and learn that I talked about earlier, 256-937-2010, that is our number.
With so many worries in life, market volatility shouldn't be on your list. Help ensure your retirement plan is stable and independent of market swings. Just get in touch with Chris Wallace at 256-937-2010. That's 256-937-2010 to start planning.
Quarters, just 25 cents. That's hardly anything, right? But Chris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Chris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Chris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Chris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
If you're pondering the longevity of your retirement savings with questions like, is my nest egg sufficient? Or how long will my retirement funds last? Consider scheduling a session with Chris Wallace. Text VISIT to 256-937-2010. Again, text VISIT to 256-937-2010 now to set up your appointment.
We're so happy that you joined us today. Thank you so much. I'm Lou Ann Fulmer. This is the Rocket City Retirement Show with Chris Wallace and Graham Bauer, both certified financial planners, and here to guide you about retirement planning. So let's get into the next question that I had. And it was actually about Social Security. We're just talking about what we can expect from our new Republican-controlled government. What do you guys think is going to happen with Social Security status?
Oh, wow. Well, I'll jump in here because I love Social Security conversations.
Yeah.
First of all, I will say this. Social Security, big decision. So there's a lot of stuff going around that it's going to go broke, and the trust funds are going to be depleted by 2035 or 34, 32, whenever it is. Everybody has their own year when it's going to go broke. We are firm believers that Social Security is not going to go broke because there are so many people on Social Security. So over 20% of the population today is actually collecting some form of Social Security. So you're telling me if it goes broke, you're going to have those 20%, 20+% of people pretty much living on the street, because the majority of people collecting Social Security today are using it for a large majority of their income. So it's a big problem that I can't see that happening. So I don't think it's going to go broke. And Graham has said before, don't treat it like a game. All right. Because that's how most people do. It's like, okay, the break-even game.
Right,
if I collect it now, I have to live so long to break even. And it's like this game. So we don't believe you should treat it as a game. So we have seen situations where, let me make a hypothetical situation that we may or may not have seen. So we have run into a situation where the individual, still working, age 69, and not collected because he's an avid TV and radio listener, and he listens to good advice that gives, that comes out on the show. And so he's still working, not collecting. So a spouse is considerably younger. So in a situation, hypothetically like this, we would say, okay, continue to defer. Okay. Even if you're sick, because even if you're sick and you pass away, I've had this argument before. It's like, oh man, if I come down with like an illness, I should just go ahead and claim. I'm like, whoa, wait. We still have your spouse we have to think about.
Right.
Because in a hypothetical situation like this, let's say someone's age 69, let's say it's 69 and a half, they pass away of an illness and they have a younger spouse. They haven't claimed. That younger spouse would be eligible for that higher amount, even though he had not claimed, up until the day he died, including all of the delayed credits.
Wow.
So this is really, really important. This is stuff that we look at, every day in the office. So I'm just making a hypothetical situation here that we have to think about Social Security not as a game, but as a strategy. And how does that benefit our retirement plan? How does that make our retirement plan stronger? Because a lot of people don't think about this. Okay, the break even. Oh, it happens around 80 years old. That's roughly when most of the break-evens are going to occur. It all depends on COLA, as we've talked about before, Graham. But with people forget about that COLA. So if you have Social Security, essentially you have kind of like what I see as an inflation-adjusted annuity that's paying payments that increase based on cost of living, every year. So, Graham, I don't know about your thoughts on that, but that's kind of mine. Is I don't think it's going to go broke, and people like you have said before, giving you all the credit for it, don't treat it like a game.
Yeah, it's super important to make the decision that's going to protect you and your spouse the most. And in a situation like that, it becomes infinitely more important, especially if you have a spouse that's much younger than you. Because what you have to think about in those scenarios is that they're going to have a much longer time horizon to cover in retirement. I would say that, just generally speaking, and if you're listening and you have a situation like this, I'm just going to say this is probably your situation because this is how I usually see it. Usually the wife is younger than the husband. That's just typically, I don't know that I've run into many situations where there's a wife that's 10, 15 years older than her husband. So in these scenarios, a pretty good bit of the time, the wife might have, stayed home with the kids, and her Social Security is typically not going to be quite as much. And maybe she, hasn't really had a super long career. So, for people listening at home, you might think, oh, well, that might not be such a big deal. She might work a little bit longer. But in a lot of these situations, the wife's not really working, even if she is maybe 10 years younger than the husband. So she's going to have a really long period of time to cover in retirement. I mean, if we're talking about a 55 to 60-year-old, that could easily be a 25 to 30 year retirement. I think women who live to age 65 have like a 50-50 or 60-40 chance to make it to 90. So for females, there's a pretty long time horizon there. So if your Social Security is permanently penalized and that's like your only income source you're leaving behind, that basically means your savings that you saved up are going to have to cover her plus the Social Security amount for the rest of her life. And if that's 25 or 30 years, that could be problematic if you don't have a really good base of savings there. So yeah, in those situations, I think Social Security is just increasingly important because of that long time horizon and, the draw that's going to pull, especially if you don't want to, end up having to be a burden to the kids or anything like that.
Yeah, I think also just to kind of add to that a little bit more, talking about a family that just has, let's just say they have Social Security, you have to think about the income loss. So if you're bringing in $3,500 a month and let's say your spouse, your wife is bringing in $1,500, her $1,500 goes away. And most people say, well, yeah, she keeps mine. I'm like, yeah, she's down $1,500 a month. And this is where I think age comes into play and experience with what I've done for quite a while now is, when it comes to planning for a family, one of the things I'm trying to figure out how to call myself a senior advisor with gray hair, 20 years experience. I've sat down with and seen a lot of stuff. And one of the things that'll happen to a lot of widows is the psychological impact of death is horrible enough. You lose your best friend. I would say in most all cases, you lose your best friend, they pass away. And that the next worry is, oh my gosh, do I have enough money? So what I have seen in these types of situations where I'm dealing with a widow is almost the feeling of I got to put everything away in a very safe spot. I can't take any risk because not only have I lost my best friend, they were doing all the financial. I don't understand this market. I don't have anybody to talk to, and I don't even know if I have enough money. So I think having someone like myself at the office that obviously oversees our advisors. I've been down that road with widows before. Now I cannot tell you how they feel because when they come in the office, it's a hard conversation and you just kind of have to listen. Yeah. There's a lot of emotions flying around. And I think as a younger advisor, and this is no knock to Graham because he's a rock star, but Graham might be like, yeah, you're going to be fine. Everything's going to be okay. But that's where I think experience kind of comes in. It's like, okay, let's deal with what they're dealing with emotionally. I know they're going to be okay. Like in my mind, if I sit down with a widow and we've built their plan, we would know they're going to be okay. But that's not what they want to hear at that time. Sometimes they just want to be heard, and you just need to just comfort them in that time. So if you're listening to the show and you're a husband, just remember that, just that it's easy for us. I'm a man. It's very easy for us to go, it's going to be fine. Like, you're good. You got the house. You can just sell the house. You can downsize. Everything's going to be great. No, build a plan that they have comfort in, that they can know that when you're gone, they're going to be okay. And that includes Social Security, to kind of tie it back to Social Security. That's why it's incredibly important, in my opinion, not to be selfish with Social Security. But it's my money. I worked, I paid it. Yeah, you did. But guess what? You also stood at the altar with that person across from you as well. And there's some obligation there to make sure they're taken care of. And I know you want that. So don't alienate Social Security as, one of these decisions that you don't have to, include in your marriage. It's an important marital decision from a financial perspective. So,
yeah. And one other thing with that income loss, and we've talked about this before, but I just think it's good to reiterate, when there is an income loss, if you're seeing a 30-40% income loss, on all likelihood, the loss of expenses for being one less person will not be 30 or 40%
No.
because your property taxes and insurance don't cut in half when it's just one person. Your YouTube TV bill doesn't. There's some expenses that will fall off, but generally, you might be thinking, oh, well, it's one less person, so they're going to spend half as much. It's really not how that tends to work out. Sure, there might be a little bit, but it usually doesn't make up for the loss of income in that scenario.
No, and we kind of project somewhere around a 15 to 20% reduction in expenses. To your point, there will not be a 50% reduction in expenses in most families. Now, I'm sure there's the one-offs out there that they can do that. But by and large, what I have personally seen and what I've sat down with is pretty doggone close to what they were spending with both spouses alive. And in some cases, it takes a little while. Just like when you go into retirement, it takes what I call this the retirement rhythm. It takes about a year to a year and a half to get that retirement rhythm going because you've been working for 40 years, 30, 40 years in some cases. And then all of a sudden you stop and now you've got to restart this retirement lifestyle. And there's a rhythm that has to happen and a comfort level. The same thing when you lose a spouse, there's a new rhythm that has to start. And I think that sometimes can take a while. And you just having someone there with you, I think makes a big difference. We've actually had people come in the office before. The guy's like, I do it, pretty much everything myself, but I am concerned if I pass away, I want my wife to have a place where she can come sit down and I want to establish that relationship. And we'd like to start working with you because of these reasons right here. And we've seen that before.
I love that. And you guys, that two of my best friends, my closest friends, have lost their husbands here in the last couple of years. So here I am, finding myself with friends talking about, that now they've joined the club of the deceased husbands and just listening to them and watching them go through this. Yeah, it's just like it scares us all because then we're all like, oh no, what would I do if that happened to me? And yeah, because we really do depend on our best friends, our husbands, and then of course just navigating everything, the finances and all that.
And if it goes the other way too, Luann, I depend a lot on my wife.
Right. Yeah.
There's a lot that I depend on Jen for. So it does work both ways. So I know we're talking about husbands, and wives in here and kind of the husband. I don't want the men to stop listening to the show because he's like, man, every show he does, he just kills all the men off. But
yeah,
so,
that's true. Yeah.
As far as like your friends, you could probably relate to some of the things we were just saying.
So
You've probably heard it.
Yeah, that's what we're talking about, but yeah, like you said, my mom, she passed away, and my dad lived another, 15 years. So in my family situation, my mom went first, so.
Yeah.
But anyway, great discussion here, and I do still want to ask something else about Social Security.
Sure.
The Social Security Fairness Act was just signed into law. And I find that so interesting. They're going to make some changes. It's actually restoring some of the benefits for Social Security for teachers and firefighters, police and postal workers. So get this, you guys. I taught for 7 years, and I always thought I probably should have taught for 10, but I just couldn't do it. But anyway, it was amazing I lasted 7 years. I did middle school, right?
What did you teach?
German, world languages. German and French.
Do you still speak some German?
Yeah, ich spreche Deutsch. Yeah.
Oh man,
you got to do the show intro in German one of these days.
I could give the weather, or, whatever.
People will be like, "Wow, they really rebranded."
Yeah.
New name,
really
it's in German now.
Yeah. 999. I would not do that.
Yeah. That's funny.
But listen to this. So my Social Security average could go up $360 a month. $360 a month with this change of the Fairness Act. So now, obviously, it's going to put us into debt over about 10 years, I think, $195 billion in federal deficits over 10 years to fund this.
They've been working on this for years. And I saw the article that you put in the show notes, and it's like, President Biden signed into legislation expanding Social Security. He's the first one in 20 years to expand Social Security. I'm like, Congress had to pass it. All he had to do was sign it.
Right. I know.
And they've been working on this for years.
Yeah,
years.
They have. So that's a good thing. But then Donald Trump, he said he's going to eliminate taxes on Social Security payments. So I don't know how all this is going to come down,
Remember what I said earlier. Trump says a lot of stuff.
Yeah, words.
A lot of stuff.
Words. You're right.
Yeah.
You're right.
Yeah, he
And
says a lot of stuff.
I do think that I'll give very quick context on what just a piece of this looks like, because I do think that government pension offset and windfall elimination, is probably two things that the average person has no idea what they are and what they mean. So just to give a quick example of why this really is a good thing for a lot of retirees, even if, it is going to cause a little bit more, is, for example, if someone, and I've legitimately seen this scenario before and, play out, not exactly like this because the spouse hadn't passed away, but if the spouse did, it's kind of what it would look like. If you were a teacher, let's say you lived in like Louisiana or something, and you had a really good teacher pension, that was maybe $70,000, $80,000 a year, but you didn't pay into Social Security. If your spouse did pay into Social Security and was eligible and, say they had $40,000 a year, a lot of times because of government pension offset, if your spouse passed away, you would just lose their whole Social Security. You wouldn't be able to collect any of it because of pension offset. Wow. So that is one thing that it looks like they're doing away with, which I think is a really good thing, because if you're a teacher, you probably didn't make that much money.
No.
And that's income that's going to be really crucial throughout retirement. So there are some pieces to that.
Interesting.
Yeah. And then there's getting into windfall. There's a lot more going into it that we don't need to get into. But I think that the average person might not totally understand how this does benefit people. And I think, we can all agree that teachers probably deserve a little bit more than they're getting. So it's nice to see teachers and firefighters and police officers, be able to maintain some of those benefits.
Sure. It also impacts some federal employees in our area as well.
Yeah.
So it's a big, if you're in that CSRS. I can't even talk. Yeah. So if you're in the in that category, it's definitely gonna help you quite a bit. So I think it's a good thing. I really do.
You guys
that and for the survivor.
Thank you.
Mm-hmm.
Yeah.
Yeah. It's really, I think, more importantly, that survivor, that GPO part of it is kind of a big deal. So glad to see it. Glad they finally got it passed through. Like I said, they've been working on it for a very, very, very long time.
Very long time. Okay. So do you want to go into any more about Social Security, or shall we just move on?
I think we can move on.
Yeah, I think so,
it's
too.
important.
Yeah, right.
Strategery in the plan is Social Security. So make it very strategic.
If you haven't picked up on that by now, I think there's like 370 other shows you can go listen to.
And if you hadn't picked up on it, there's no hope at this point for you.
Well, okay. So now what I want to get into are just the threats of taxes and inflation. Let's kind of go there. Okay. We have a lot of risks in retirement. But all these challenges kind of coming at us, the market downturns, we know that could happen in the future, of course, and then higher taxes, inflation, and all that kind of just hitting us all at once. Let's just talk about that and how you guys help people stay ahead of all of these challenges.
Well, first of all, we kind of make the description or the analogy that retirement is a lot like a Rubik's Cube. And if you think about it, taxes, it literally touches almost everything that we do in retirement. So it can touch our Medicare premiums. It can touch our IRA and how much we withdraw and how much taxes we're going to pay, capital gains. Our pensions are federally taxed. In the state of Alabama, there is no state tax, so they're not state tax. But taxes can literally touch everything. So one of the things that we do in the office, actually, I was working with my paraplanner earlier today on a Zoom call with her, and we were just going through some prospect notes that for somebody that came in the office. And I was literally just kind of walking her through it on how to look at it from a tax perspective. So as we, went through the meeting and I made my notes and she's making her notes, one of the things I drew her back to today was, okay, now let's just go through this and listen. I want you to listen to numbers, and I don't want you to think about anything but the tax impact, because I think in retirement, I know you can control a lot of the taxes that you pay by the decisions that you're making on your Social Security claiming, how you withdraw income out of an IRA, how you pull it out of a non-qualified account, how you charitable gift, you can control your taxes and actually help your taxes. So that is how we do it, Luann, as far as how do we help retirees stay ahead of this, is thinking about how can we better themselves from a tax, or better them in a tax perspective. Because when you're talking about, financial advisors and, some people are like, I don't want to pay, their fee and, all this stuff. And I've had people calling, what do you charge? And how do you get paid? I'm like, okay, cool. We'll go over all that in the meeting. I promise you. But I've had people say, I don't want to pay the fee. part of my job is to hopefully make the plan as efficient as possible and maybe even squeeze out a few tax savings penalties just by reallocation of things or the way that we withdraw things that most people don't really think about. And again, I'm not a CPA. I can't give tax advice, but as a CFP, I've been through the tax course and I spend a lot of time as a business owner trying to understand taxes and how I can help families in the Huntsville area kind of save on taxes. So, part of our fee that we charge, is to, manage the investments, right? But then, we should probably be working for that fee in other capacities as well. And that's one of the areas that we do it internally. We take a heavy focus on that. I know Graham's been brought up that way. He's like my at-work son, if you will, and he knows how to look at that and he can sniff out when, hey, you can move this over here, or you can do this, and actually will be a little bit more efficient.
All right. So, our concern right now is the fact that our national debt is $36 trillion. Okay. So everybody's worried about how this is going to affect someone's retirement. Our retirement's going to last 20, 30 years. So this is an unknown, one of those unknowns where we know taxes are going to go up. How much? Anyway, let's kind of get into that. And again, the tax stands for taxes in the right retirement process, your process. So taxation, you get into that when you're working on a plan.
Oh, for sure. So national debt being 36 trillion. I mean, we can't continue, or I say we can't. I mean,
we shouldn't.
We shouldn't. We can't do it at home. I can't run up my credit card just unlimited.
Exactly.
I don't see how in the world we are able to do it as a country. But anyway, we should not continue to be fiscally irresponsible. And we can't really, I guess, continue at the same trajectory, at 36 trillion, because if we do, one of the ways we have to pay for that, or we'll have to pay for that, will be taxes if something's not done about it. Now, I know, again, Trump's tariff this, tariff that, but that's a lot of debt to overcome. So we're kind of in the camp that we probably will see taxes go up in the future. But I'm also not in the camp that they're going to go to top marginal rate in the 90% range. But I do believe at some point they have to go up because we do have to start paying for some of these mistakes. Side note here politically, I do like the Department of Government Efficiency situation. Again, I don't think they're actually going to be political positions per se, like actual government positions.
Right.
But to have someone scrutinizing some of the spending, like how can you not get on board with that, whether you're Republican or Democrat? I just think that's a good thing because I believe if we're going to pay our taxes, that we need to kind of know transparently how our money's being spent, and we want to make sure that it's being spent efficiently. So aside from that, yes, we get into taxes a lot in the office. That is a T in the process. We look at tax efficient strategies. One of the things we're not fans of, and I hear this talked about a lot on other shows, I've seen it on TV shows as well, is cash value life insurance and taking loans against that. That's just not the avenue that we like to go down. We think there's other tax efficient ways to handle your money, and life insurance being as an account to borrow against. And it's not one of those. And I'm sitting here laughing because I see online they have all these different names for these accounts. I don't know if you've seen these online, Graham. They go in and they pick out these IRS codes, and I think it's like the 770 account or 770 account.
Try to make it sound like really fancy. Something. It's like when I can't remember exactly what it was, but there was this type of fish that was like not selling at all, and so they just named it like the tropical snook of the West or something, to just make it sound really fancy. And even though it was just like a very common fish that you could find everywhere, I feel like that's, exactly what they're doing with that we could really sound fancy if we went out and pulled the actual the section of the IRS code that everything appeared in.
It's basically, I just Googled one because I couldn't remember the name of it, but it's like section 7702.
Yeah.
It's like the 7702 plan. And do you have a oh no, I don't have a 7702 plan. What is a 7702 plan? It's a sales tactic. That's what it is.
Yeah. It'd be like if someone came into the office and we were like, do you have a profit sharing plan with a cash or deferral arrangement?
Yeah.
It's just like, just say 401k, that's what you're describing
Yeah.
there.
Exactly. So that's just not something we get into at the office. We prefer not to be salesmen at the office. We're basically building plans trying to make sure your money's going to last, establish income, look at your diversification. Yes, tax efficient strategies is one of those, Luann.
Okay. And then real quick, in just a couple minutes we have left, inflation, I can't even believe it's been 2-3 years ago that it soared. Again, we didn't really see it for a long, long time. Talk about how inflation imposes a very significant problem for those in retirement. Obviously, we understand why, but how do you guys deal with that?
Yeah, so it's a problem. We've seen and I've said this a number of times on the show. Sometimes I feel like I'm repeating myself, and it's all good.
Okay. That's our
Yeah.
topic,
So inflation, it's not necessarily the inflation that's the problem. It's that elevated permanent price that's really the problem. So like today's retiree that's retired in the last 2 or 3 years, they've kind of got the short end of the stick, because if you retired in 2022, you retired during a down market, both stocks and bonds, and then you had runaway inflation until the Fed's kind of got it trending down again in terms of year over year. But as we use the example of the $5 hamburger that is now the $12 or $13 hamburger isn't going to go back to $5.
Darn it.
So if you retired in the last 2 or 3 years, it's congratulations, your retirement's much more expensive than you probably anticipated. So that's really a problem for the retiree, because other than Social Security, you're not going to have inflation adjusted income. So if you're fortunate enough to be military or federal government, then you have inflation adjusted Social Security, your pension's inflation adjusted. But the majority of people out there don't fall into that category. So for the retiree, it's a lot harder. And therefore, I think you should have your money in a position or invested in a way that does outpace inflation, because you're going to need to do that, or you're going to lose purchasing power throughout your retirement. And we've seen it in the plans. In the plans that we're building, higher inflation obviously creates a pretty big drag on the plan. And just speaking about inflation, I mean, my goodness, the cost of eggs here lately. And my dad's like, it's the bird flu. I'm like, okay. I'm thinking about getting some chickens, man,
Hey,
because
I know. We have chickens in our family. Not me,
Man.
but my daughter's mother-in-law.
yeah, I mean, the cost, and we eat a lot of eggs at the house, and just the cost of eggs has just gone through the roof. So anyway, it's the permanent elevation in price that's a problem, but also the long-term inflationary effects, and how it just really increases the cost of your goods you're purchasing over a period of time is something you've got to build into the plan. You've definitely got to structure your investments, like I said a few minutes ago, about in a way that outpaces that inflation.
All right. So it all boils down to finding the right financial advisor to guide everybody through these challenges that we're experiencing in retirement. That's why we do this show every weekend, Chris.
Yeah, it does, Luann. And whether it's us or somebody else, we encourage families to go talk to somebody that they can find trust in. Sometimes it's us, sometimes it's not. It's fine. At the end of the day, we do this show to be helpful. We want to make an impact in the community. We want to make sure that people have what we consider to be credible information that they can take and implement certain things. I mean, obviously there's things that we can't get into because it's very granular. That's kind of in the office kind of a stuff that we do. But again, whether it's us or whether it's somebody else, just find somebody in retirement that you can trust in, that you can sit down with, that if you're gone, your spouse has a place to go, so he or she is going to be okay, and just make sure you're comfortable. Anyway, that's it for the show, Luann. Great show, a lot on Social Security. Make a good decision in retirement. Again, whether it's us or not, if you want it to be us, hey, great. Give us a call, 256-937-2010. That's our number to set up a discovery session. Leave a message with our call center. We'll call you back and set that discovery session up. Again, it's 256-937-2010. Hope everybody has an awesome and blessed weekend. And remember to serve every person in every situation with a servant heart.
AEWM provides services without regard to political affiliation, and the views of individual advisors are not necessarily the views of AEWM.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisory requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.